Good morning. My name is Susan Galinsky.
And I'm Denise Grace, and we're the founders of G Squared. So, for the best information and advice on how you can have a successful retirement, subscribe to our YouTube channel and hit that notification bell so you'll be notified whenever we upload a new video. So, today's lesson is kind of unique. We talk a lot about contributing, transferring, or converting money into a Roth IRA, which of course means paying the taxes now, and we all know that's no fun. So now we've got this tax-free account, and it's going to grow, and you'll be able to pull money out later in retirement tax-free. Or you can just let it sit and accumulate and pass it on to the next generation who won't have to pay any taxes on it either. So it's really a wonderful thing. So let's talk about when you start pulling money out of there. And we could make this real simple and say it's all tax free. But depending on when you do it, what the character of it is, there are still some rules that you need to follow. There are specific rules depending on your age and depending on timing. And if you get it wrong, this whole great benefit of tax free goes away. And remember, if you have questions after viewing this video, call us because, again, it can get somewhat confusing. So here we have on slide 1, these are the main talking points, aka the main rules. And we'll have these available for download. So if you want to download them before watching, then you can take notes as we go along. Slide 2, this is all the details. And yes, it's pretty busy. And yes, Susan gives me a hard time because I like a lot of detail. Maybe it's the engineer in me.
But I use the KISS method, Denise. Keep it simple.
Know. It walks you through an example of contributions, conversions, and the earnings. And if you take the time to study it, it really does make a lot of sense. Slide 3, this chart really does a pretty good job of just simplifying everything, talking you through what those rules are and when you can access your money. And that's really what we're here to review today.
So let's go back to slide 1. First is the distribution ordering rules. How's the IRS going to look at your distribution? In order for your money to come out tax-free, first and foremost, you're going to need to be 59 and a half years old to withdraw from the account with no penalties. You still have to do an accounting of it. And a lot of people that are listening today, they do have a few Roth IRAs, similar to Denise and I, that you started on your own. You contributed to it for a few years, and possibly it's grown some. And then we also have the ones that were converted from a traditional 401k, 403b. If you're a FERS employee, you rolled over that money from your TSP into a traditional IRA, and then you turned it into a Roth at some point. So we have a lot of clients, they've got 2, 3, 4 Roths. And to simplify this, what the IRS is going to look at is they're going to combine all those Roth IRAs as one big account for distribution purposes. So keep this in mind and understand that this does not apply if you have a corporate Roth 401k. A lot of companies have an option within their 401k to contribute to a Roth, but that's a corporate Roth. It's not a personal Roth IRA. And we need to define one other important point here, and that is what's called the 5-year forever clock. So what's the 5-year forever clock? Well, it starts when you opened your first Roth IRA, regardless of whether you did it 20 years ago, 7 years ago, and even if it was just $100, that's the start date of your 5-year forever clock. So if you don't have any Roth IRAs, you might want to think about opening one up, because once you do, now your 5-year forever clock is going to start from 2024. And even if you just put $100 in it, this gets your 5-year forever clock established. And you would be able to, after 2029, be able to take the money out with no penalties.
So let's talk about what are the Roth IRA distribution, the ordering rules. Where this becomes really exciting is once money is established in a Roth, It's really cool to look forward into your retirement and know that you can draw this out of this account and it won't be added to your bottom line of income, which translates to no added tax to your Social Security. Or, like I said earlier, we can just leave it there for your whole life, pass it on to your beneficiaries, and they're going to inherit an IRA tax-free. So let's walk through the 3 steps of characterization of money coming out of the Roth. And again, this only applies to Roth IRAs. It does not apply to corporate Roth 401ks or IRAs that you may have. That's a whole nother set of rules. So it's important to know that the first money coming out when you take a distribution are the initial contributions that you made. The next is conversions. This is where you take your traditional IRA money, pay any taxes due on it, and then convert it to a Roth IRA. That money is second. And then finally, the earnings is the last money coming out. But one thing that's important are the contributions. This is money that you've put into the Roth IRA, and it's after tax money. So you never have to pay a tax or a penalty if you draw that money out because it started out as after tax money. So regarding the contributions, you can always take that money back out, regardless of age, regardless of when. And so that's something to keep track of. And it's helpful to know that that's the first dollars coming out. If you have to take money out, it's kind of nice to know that it's available there, but we don't want you to do that unless it's absolutely necessary because, that's really intended for your retirement or passing on to beneficiaries. So the next one on the list is conversions. This is where you've taken money from a traditional IRA and you've converted it to a Roth. So you didn't contribute in that present year. There are no limits on how much you can convert into a Roth IRA, unlike your contributions where, the IRS sets up limits based on your age and your income. So it often gets confused. It's important to understand the difference between contributions and conversions.
So let's talk about if you're under 59 and a half and you're doing a conversion. And now we have a different set of rules. This is the one instance where you have to keep track. So we're under 59 and a half. Say I'm 55 and I convert 10,000 3 years ago, 10,000 2 years ago, 10,000 last year. I have to keep track of each of those conversions, and each one of those has their own 5-year clock before I can pull them out penalty-free and tax-free. Now, if you're over 59 and a half, you do not need to keep track of each one. You only have to keep track of when the first Roth was open because that's what established your 5-year forever clock. But again, if you have questions, just give us a call. Conversions obviously are going to be handled differently based on your age. So looking at clients that are 60 or older and retiring, let's say they never put money in the Roth and they want to do that first Roth conversion. Well, if that lifetime 5-year clock rule hasn't been met, then the earnings could still be taxed. So it's important to remember that because the whole joy of a Roth is that it's growth tax-free with your interest and dividends. And we don't want you to miss out on that by making a silly mistake or some silly mistakes. So within the scope of financial planning, we use Roth IRAs and Roth conversions frequently so our clients can have a tax-free account later on in retirement, or if they so desire, they can hand a large chunk of money over to their heirs that they're not going to have to pay taxes on. And again, this strategy can have a big impact on your future RMDs, reduce them for you. So now you have a lower tax liability. They also do not get included when the IRS is looking at taxing a portion of your Social Security. And then you have your Part B monthly premium. That Part B monthly premium is based on your income every year. And if you're taking a large amount out of your Roth IRA that particular year, it's the only thing that is not counted as income when Medicare is determining whether your Part B monthly premium should go up because your income went up significantly that particular year.
So if you'd like to see how Roth contributions and Roth conversions might affect your retirement portfolio and your future taxes, just click on that Calendly link below and we'll schedule a brief chat. We will also provide you with a written plan that outlines your roadmap to a successful retirement.
Absolutely. And if you liked this video, then give us a thumbs up, subscribe to our channel, share it with a friend. We always love to educate new people, and hopefully they become new clients. And to that point, we hope something really good happens to you today. And remember that G Squared, we're all about valuing, building relationships beyond investing. See you on the next clip.